Hello everyone and welcome to our new session on how to trade the financial markets professionally. My name is Yazan Shakfi. I'm the Chief Market Analyst in One Trading Markets. Today our training will be focused mainly for beginners, but also it will provide some information for people who are already trading in this market. So the duration of this video or of this session will be around 1 hour. We're gonna introduce you about what is a foreign market and why to trade via a broker, and then how to read the codes, how to read the prices, and then a quick guidance on the trading platform that you're expected to trade on. And the most exciting part, which is the analysis, how to analyze the market from fundamental point of view, which is fundamental analysis, and technical point of view. And based on those type of analysis, we're gonna come up with a simple, quick, effective trading strategy that you can use while you're trading. And anytime you can drop your questions in the question button that I told you about, and after each section I'm gonna review all of the questions and I'll try to answer all of your questions before we end this session. So let's start with the important definitions. So what is foreign exchange, or they name it Forex, FX, it's all referred to the foreign exchange markets. Foreign exchange markets is the market where you trade the major currencies and other important international products, and it's the largest market in the world. Approximately the daily value of trade on this market is over $5 trillion. So it's around $5,000 billion traded a day. It's an uncentralized market, so there is no physical presence for this market, like the New York Stock Exchange or London Stock Exchange or Dubai Stock Exchange, etc. It's an uncentralized, it's based on a big network spread all over the world. That's why it's working 24 hours a day, 5 days a week. The main advantages of Forex trading is, first of all, it opens 24 hours a day, so even the full-time employee can find themselves 2 or 3 hours to analyze, trade, and be part of this market. It's very high liquid market, so this is a very interesting advantage comparing to other type of investments like real estate and others. It's very transparent because of the high volume, so no one can manipulate the market. And the interesting thing is that you can benefit from both sides of the market, which is the upside and the downside. Usually when you are investing in real estate, for example, and you're expecting prices to go up, so you buy and wait for the prices. When the prices go up, then you sell and you make profit. But if you're expecting the market to go down, then you don't have anything to do but to wait for the market to go down. So in this case, you lost the opportunity to make profit based on this expectation. But in Forex, no, you can start with something called short selling. So you sell, and when the value of the asset you sold decrease, then you buy it again and you make money from this difference. And also the high leverage. We're gonna go through them one by one. So market opens 24 hours a day, starting with the Australian session, followed by the Japanese session. By the time the Japanese session ends, then the European session opened, and then followed by the US session, and again, while the US session closed, then the Australian session opened again. So the market opens on 24 hours a day, Monday to Friday, and Saturday and Sunday is off. It's very high liquid. Also, this is the second advantage. It's very high liquid, as I told you. Why? Because it has so many participants, and this is what creates the huge volume that we are talking about. the daily trading is around value is around $5 trillion every day, because we have so many participants, like traders like me and you, the retail traders. Central banks also are part of this market. Private banks, they're dealing with currencies, so that's why they are also involved. We have also the investment funds, the hedge funds, and even the commercial companies. For example, if I am a Toyota dealer and I would like to import Toyota cars and I'm in the US, then in this case I need to send Japanese yen. So in this case I need to be in part of this market for sure. And also so many people, they do what called hedging. So for example, if I'm expecting cars to come to me, or if I'm expecting a payment in Japanese yen to be made after 3 months or 5 months, and I'm not sure about the value, so then I can do forex trading just to hedge my risk. But this is not our topic for today, so that's why so many people are involved in this market. In terms of transparency, as I told you, the huge volume brings transparency. No one can manipulate the market. If you would like to manipulate the market, you have to make a trade worth $5 trillion. And in this case, you will manipulate the market for like 1 or 2 seconds. And this is almost impossible. So that's why it's very transparent. No one has the upper hand. No one has the big power. In addition, the prices are disseminated all over the world. So if you open Bloomberg, Reuters, any economic channel, you can see the prices spread all over the place. If you go to the mall and you see the exchanges, you can see the rates. So for example, you cannot see euro dollar quoted at 1.11 and another broker like us, for example, One Trading Markets, quoting it at a totally different price, like at 1.4. This will not happen at all. While, for example, this will happen in real estate or other markets if the markets are not centralized or if not standardized. So you can see this. You can find a broker listing a house for X and another broker listing another house for X plus 16 or something. So the variance is really high, while the variance in FX is almost nothing. Okay, now the most interesting and important advantage also is the leverage. Leverage, what is leverage? Leverage is a service provided by a broker. Let's first agree on one thing. When you would like to buy shares, for example, or any financial product, you cannot go directly to the company and tell them, hey, I would like to buy shares. For example, if you're interested in Coca-Cola shares, you cannot go to Coca-Cola company and tell them, yes, can I have like 5,000 shares? This will not happen. The system is like you have to go through a broker, you open an account with them. This broker has access to this market. He has the right to access to this market. So he will open an account for you. You fund this account, and this broker will provide you trading platform where you can process your trades, whether to buy or to sell. So this broker, most of the brokers in the local market, for example, they offer you a leverage. What's leverage? Leverage means giving you extra purchasing power. What does that mean? That means when you deposit, for example, $1,000, they will tell you you can purchase a value of shares worth of $2,000. Okay. In this case, if you make profit, let's say 10%, so the profit for you will be 10% on 2,000, which is $200. But in practice or in reality, you're making 20% because you make 200 out of $1,000. So this is called leverage. They are maximizing your profit. But at the same time, when you lose 10%, that means you're losing $200. So actually you're losing 10% of the portfolio, but actually you're losing 20% of your capital. So in this case, they are maximizing leverage, can maximize your profit, but at the same time can maximize your losses as well. So that's why leverage, so many people make a risk warning about leverage, that it's risky if you're not using it pretty well. but at the same time, if you're using it properly, this will maximize your profit. So local markets or local brokers for local stocks, they can offer you 1 time, 2 times, 10 times the value of money you are dealing with. However, for Forex brokers, because of the high liquidity, they can provide you up to 1 to 400 times the money that you have. In one trading markets, for example, when you deposit 1,000, you have the purchasing power to trade $400,000. Whatever money you make from this $400,000 is for you. However, you cannot lose more than $1,000 because the company does not share with you the profit. Thus, they don't share with you the losses. So this is the idea of leverage. Some people might ask, why the broker is giving me this? Like, what's their benefit of that? The answer is this is simply it's a win-win situation. The broker will make money when you make more trades. That means more commission. And at the same time, if you're using the leverage properly, you are maximizing your profits in case the market go in favor with you. So that's why it's a win-win situation. The broker would like to utilize the money he has to generate more commissions, and as long as he's protected from losing the money, because the moment you lose your capital, the broker has the right to close all of the positions. So in our example, when you put 1,000, the minute your portfolio lost 1,000, the broker has the right to close all the positions. So some people might ask me, okay, Yazan, what you're saying is all right, but why do I need to go through a broker? As you told me, what if, for example, I have $300,000 in my bank and I will split them into 3 accounts, one in Japanese yen and one in euro and one in dollar. So I will keep $100,000 and I will exchange the other 100,000 to euros and the third 100,000 to Japanese yen. And then I will do my math. I will do my analysis. If I'm expecting, for example, the dollar to go high against the yen, so the rate of dollar yen to go high, so then I will sell the yen and buy the dollars. If I'm expecting, for example, dollar to go higher against euro, if I'm expecting dollar to go high and euro to go down, so I would just sell the euro and buy dollar. So when you're exchanging from one currency to another, you are selling this currency. So the currency you're giving up, that means you're selling it. And the currency that you're adding to your account, this is the currency that you are buying. Okay. So in this case, I can do this exercise without having the access to the broker. I will tell you, yes, you can do that. However, to do so, you need to have a huge bulk of money. In our example, $300,000, because you know the fluctuation of the currency is very limited. It's very small. Like in the whole month, maybe it will move like 0.5% if it's very active. So if you're just dealing with your capital, it will make nothing to you. So that's why the broker presents leverage to help you trade larger amount using small margin. So in this case, the 0.5%, if you're using a 400 or 100 leverage, this will make 5%, for example. If you're using 400 times, this will make 20%. So that's why in FX, in the brokers, they provide you leverage, because to do, in our example, to do the $300,000 example explained earlier, all what you need is to have $750 if we are providing 400 leverage. I will show you how we calculate this. And this 750 is called margin. Okay, so I will explain it now in the trading platform. Okay, so let me go take you through the trading platform a little bit. Okay, so this is the trading platform. So we have 3 main sections. I wonder if you can see it properly. So we have three main sections here. The first section is the product sections. So here is the list of all the products you can trade with one trading market. You can see there is major currencies like euro, dollar, pound, dollar, etc. You have the index, the gold. You have silver. You have US shares, Apple, Caterpillar, Google, IBM, etc. You have the international indices like Dow Jones, Nasdaq, S&P, Nikkei, and also you have oil and gas, and also crude oil, natural gas, and cryptocurrencies, which is the Bitcoin. So let's say, for example, you would like to trade the dollar yen. Okay, so we go to the USD JPY, you double click on it, and you get this basket, or you get this ticket. Okay, so first of all, my account is $10,000 now. So in our calculation, the $10,000 can open for me trades worth 400 times the capital. So I have now $10,000. I'll just open the calculator. $10,000 multiplied by 400. So I can trade up to 4 million. Okay, and this product, this is a demo account, by the way, so everything is real except the money. So we made this demo account on 500 times. So in this case, the $10,000 multiplied by 500, you can trade the value of 5 million. Okay, so let's now simply trade only $100,000. Here the volume, it's measured with lot. It's just for the ease of use. Instead of typing 100,000 here, we just put one. One in the volume means 100,000. Okay, if you'd like to trade more, 200,000, 300, 400, etc. If you want fractions, you can do 0.1, which is $10,000, for example. So let's say now I would like to buy 100,000. Okay, and I make a trade. I will just get a confirmation. And here you can see that the margin that was not deducted, that was freezed from my account, was 200. Where did we get this 200 from? So the value of the transaction was 100,000, as I told you. If we divide it by 500, so this is the 200, is the amount that is freezed from my account against this trade. Think about it this way. If you're going to a car showroom and would like to buy a BMW, for example, and the price of this car is, let's say, 200,000, of course you don't have 200,000 now, so you just block, or you just reserve this car for like $1,000. So this is exactly the same how we deal with the financial markets here. So we're dealing with reserving. So with the $200 here, you reserve a value of $100,000. Okay, when you close this position, okay, we bring back the margin to the account again. Okay, plus the profit if you're making any profit, or minus the losses. So you can see here there is a loss of $18. So you have, my balance was 10,077. Okay, there was a margin of $200. Okay, so now my account value is currently at free margin, sorry, here is 9,858, which is the 200 deducted and the losses that I have. So free margin means the amount that I still have to use for opening more positions. So from $10,000, I use now only $100,000, but I can use up to 5 million, but I just used in this transaction $100,000. Okay, so when we close it, and equity means when I close everything, how much my account value will be. So for example, if I double click again, I would like to close it. How to close it? We just double click on it and we click close. You see, you can see that the margin came back to the account again and deducted $16, which is my losses. So now my new balance is $10,060. So this margin will not be deducted forever. It will be just freeze from your account. It's against the leverage. It's just a guarantee against the leverage that you're having. So this is the system that we are dealing with in Forex trading. So we have leverage, and on the other side, we have margin that we freeze from your account against the leverage that you are taking. Is there any questions so far? If you have any question, just type it in the question button, and I will just answer your questions when I move from one subject to another. Okay, so let's get back to our session. So how to read currencies in general? Currencies usually comes in pairs. When, for example, what does it mean? Like, for example, when you go to the mall to exchange, or you go to an exchange house and you tell him, hello, I would like to buy dollar. He'll tell you, okay, what currency you will give me so I can give you dollars. So you can, like, currencies cannot come in one part. It has to be paired, okay? So you cannot tell him, I want to buy dollar. Okay, what are you going to sell? What are you going to give me? What the currency that you are giving to the exchange, this is the currency that you're selling. And the currency that you will get from the exchange, this is the currency that you're buying. So usually currencies comes in pair. So euro dollar, for example, it has a price. Pound dollar has a price. This is the exchange of dollar to £1, the Japanese yen to $1, etc. Okay, so always the currency that comes first in the code, we call it the base currency. Sorry. Okay, and the currency that comes in the second, we call it the code currency. Okay, and the number here is the amount of code currencies you have to have in order to exchange to base currency. What does that mean? That means to buy €1, you need to have $1.11623 and vice versa. You can see also that prices always come, like there are always two prices to the pair. One is slightly higher than the other one. You can see here 1.11623, and this one is 1.11615. So this difference, we call it spread. So this is the broker profit. When you go and exchange $100 to dirham, for example, they will give you $376, for example. Sorry, $100, they will give you 367 dirhams. Okay. If at the same second you tell him, no, khalas, here is the 367 dirhams, I want my $100 back, he will not give you the $100 because the rate of exchanging dirham to dollar is different than exchanging dollar to dirham. So buying price is different than selling price. Always, as a client, you buy at the high price and you sell at the low price. And the difference is the spread. We call it spread. And this is the profit of the broker. So as I told you here, when you go to the euro dollar, for example, you have a buying price, which is 1.2229, and selling price, which is 1.2227. So the lower the spread, the better the company is. It's like the exchange. When you are getting a better price from an exchange, so you prefer this exchange. Usually our spread is around 0.0001 only, but because the market today is closed in the UK and the US, so that's why the liquidity is a bit low, so that's why the spread is a bit high. Okay. Anyways, so as I told you, in terms of volume, volume is a method of measuring how much you'd like to trade. So as I told you, one means 100,000 of the base currency. So here, one means 100,000 euros, okay? And buy is the buying price, sell is the selling price, and the difference is spread. Any questions so far? How fundamentals work? Like I saw you always buy pound and based on fundamental. I think because other digital. Okay. Okay, I will answer those questions. It's on the second part. Okay. All right. So this is basically the fundamentals on how to trade the market. Okay. Now the interesting part, or before going to the interesting part, we have also one thing to explain, which is a pip. A pip is a method of measuring the fluctuation. It's like measuring the, like for example, when you are measuring the distance in meter, we are measuring the fluctuation in pips. So instead, for example, of saying that the euro dollar went out by 0.0001, we call it as like the market goes up by 1 pip. Usually, traditionally, the pip is the fourth number after decimal for most of the products, except for gold and dollar yen. So if the market is now 1.2684 and after 1 second becomes 1.2685, that means the market goes up by 1 pip. If becomes 1.2683, that means the market goes down by 1 pip. So instead of saying the market goes up by 0.0001, we just say 1 pip. It's just an easy way of dealing with the things. Okay, so before going to the exciting things, let me go to the questions. No more questions so far. Okay, so now we learn about the products, we learn about how the margin and the leverage, and now the interesting part, when and how to trade. This is based on analysis. Believe me, guys, don't rely on only people talking that I can see this is going up and this is going down. It's not magic. It's just based on analysis. Sometimes we are right, sometimes we're wrong. We're human, like any other traders. Don't believe anyone is always making profits, because we're human at the end. So we sometimes make good decisions, we sometimes make bad decisions. Okay, however, there are two ways of analyzing the market. One is fundamental analysis and the second is technical analysis. Let's go with the fundamental analysis. To explain the fundamental analysis, I will explain it in, for example, buying Apple shares, for example. Buying shares means you will be partner in this company. Okay, so if I ask you, for example, if your friend, for example, tell you that offers you to be partner in his project or in his shop, the first thing you will ask is how the shop is doing. Is it generating money? Show me the accounting. Let me talk to the accountant. How much money you're making every month? How much is the expenses, etc., etc. So the financials is important. The sector you are investing in is very important also. The competitors. So those type of things are called fundamental analysis. So for example, when I'm investing in Apple shares, I need to have an idea about the revenues, quarter on quarter, month on month, the expenses, the profit, the market share comparing to Samsung, for example, or other, like we can see now Oppo is going, Huawei also is getting part of this share, etc., etc. So those types of information that you have, and then you build your decision based on, this is called fundamental analysis. Fundamental analysis is very straightforward when it comes to the stock market. However, for Forex or for currencies, it's a bit more complicated. Why? Because when you are trading currencies, when you would like to make fundamental analysis on currencies, you need to evaluate the economies, because the currency is the reflection of the economy. If the economy is doing well, then the currency should perform positive, and vice versa. So that's why when you are fundamental analyst and when you are doing your research on currencies, you have to have an idea of the main drivers of the economy. What are the main drivers? First is the unemployment. So the more unemployment, the more people unemployed in the economy, the worst for the economy, and this will affect the price of the currency. And this is what happened in the US. You saw the jobs reports last month was worse than expected, and this drive the currency down. Factory orders. More factory orders means more business, and this will reflect positive. Inflation. More inflation, especially above 2%, is not good for the currency. If it's below, that means there is a recession, and this is also not good. So always inflation should be around 2%. If it's above or below, this is not good for the currency. Interest rate, of course, the higher the interest rate, the more happy the depositors will be, and we can see so many people convert to this currency to deposit. So any currency would like to increase the value of the currency, they will simply just increase the interest rate on deposits. And QE, which is quantitative easing, the thing that we are seeing now, we saw it in 2009 and now we're seeing it. Quantitative easing means injecting money in the economy just to stimulate the economy, and this is what we are seeing in the US now. They are stimulating around $8 trillion so far, just to make sure that the cycle of the economy is working. So even the non-workers, they can still receive money now, so they can purchase their goods. Purchasing their goods, that means the shops are working. Shops working means the people are working in shops are still in there, so people in shops can still have purchasing power, and so on and so forth. So they are just injecting money just to make sure that the cycle is going through. So these are the main drivers now for the economy. Most of the figures are coming in numbers. So always there is something called economic calendar. You can see it in the website. It's showing most of those news and the currency that will affect this news, how important of this news, and what's this event, and it will give you the actual figure, the expected figure, and the previous figures. So if we have a look at it, if you can just click on the economic calendar, you can go to www.onetradingmarkets.com and go to the English part. Can you guys hear me? Because I saw that some people cannot hear me. Can you guys hear me? Sorry. Okay, so you go to so we go to the economic calendar section. So the economic calendar section is showing all of the news that are coming to the economy and the currency that will be affected and the time of it. Okay, and you can change the time frame here based on your country and see the previous figure and the expected figure or the forecasted figure is the average expectation of the analyst and the actual. So basically the news, if it's coming better than expected, if it's positive, we put it in green. If it's negative, we put it in red. And if it's a neutral, we put it in black. Okay. And this is the currency that will be affected. And this is the news itself. If you didn't understand what's that, so you can simply click on it. So the current account for Canada, it comes at 1.1814. The forecast was a deficit. So here there is an explanation. Canada current account reflects the net trade balance, the difference between export and import. So before there was a deficit, they were import more than export. Now becomes export more than import. So this is good. And this shows you the history of this figure from 2009 till now. Okay, so these are the news that you can see on a daily basis on your calendar, and you can make your decision based on it. So if it's above expectation, they put it green. If it's below expectation, they put it red. Let me go to previous week just to show you. You see, if it's negative, they put it in red. If it's positive, they put it in green. And if it's neutral, they put it in black. So this is how we simplify the economic calendar or the fundamental analysis. So some people cannot hear me, I think. I don't know what's the reason. I think there is an issue with their microphone or something, but I can still have some people saying that they are hearing me well. Okay, so this is for the fundamental analysis. For the technical analysis, it comes as a solution for the drawbacks of the fundamental analysis. So the advantages of fundamental analysis is that it's straightforward. It's news coming to the market. If it's positive, I buy. If it's negative, I sell. Okay. However, the drawback of it is that it's not giving you the full picture. Sometimes you are trading on one news, like for example in Canada, the trade balance, for example, or in the US, I'm trading inflation news. However, the market is focusing now on totally different thing, which is, for example, in US, the labor market. Okay, so for example, if you are trading because the inflation is high and you're selling while people are expecting the labor market to go better and they're buying, in this case, maybe you will be in the wrong direction. So the fundamental analysis, unless you are aware of each and every single part of the news, it's not giving you the full picture. So that's why technical analysts said, let's just make a way of seeing how the hot money is working, how people are reacting to the market through the price movement. If we can find a way where we can analyze the behavior and where the hot money is going through the market movement, then we know exactly what people are reacting to these news. So analysts, technical analysts, they don't care about the news, they care about the reaction of this news to the market. So there are so many indicators that can explain to you how the market is reacting to the news, or to how markets is reacting in general. We select for you three main indicators that I usually use. First one is called trend. Second one is support and resistance. And the third one is the moving average. Okay. Sorry. So let's start with the trend. Let's first agree on one thing. There is no asset on earth going up or going down forever without moving in some retreatment, on some retracement. Okay, why? Because let's, for example, say that I bought a house worth $1 million. Okay, and the price of real estate reached now, like my house market price reached $1,700,000. Does that mean that I have $1,700,000? No, I will not have it unless I sell it, right? So this action, we call it profit taking. I sold it because I want to take my profits, okay? So when so many people do so, this will generate a small downside movement inside the big side movement or inside the big wave, okay? So when we usually see the chart of the market and we see that the market by time is making higher highs and higher lows, that means there is a positivity in the market that is pushing the prices higher and higher. And even when there is a down movement, it's not major because it's not reaching the previous low. So we consider this as a profit taking, as the example of the real estate that I told you. That means people who were buying at lower prices, they're just enjoying their profits. They're making something called profit taking, okay? So when we always say that trend is your friend. When you see the trend is up, you buy with it. If you see the trend is down, you just run away or you make a short sell with it, okay? So as I told you, the uptrend is a series of higher high, higher lows, okay? When do we say that the market is changing the trend? Simply when the sequence is not valid anymore. Have a look here at the example. The market by time was making higher highs and higher lows. The high was going higher and higher, and the lows also were going higher and higher. We reached a point where there was no more purchasing power pushing the prices to go higher. Why? I don't care. As a technical analyst, I don't care. That means there are people are running from this stock or from this asset. They're no longer interested in buying and pushing this price higher. So we start seeing lower high and lower lows. So that means the sequence of the uptrend is now changed, and now we start having a downtrend. What is a downtrend? Downtrend is exactly opposite to the uptrend. It's a series of lower lows and lower highs. What does that mean behaviorally? That means that the market is under pressure to the extent that the market price is always getting lower and lower and lower. And every time the market was trying to go up, it was not able to reach the previous highs. So this means the market is in downtrend, which is lower lows, lower highs, okay? When do we say that the market is changing this downtrend? Simply also when the highs and lows sequence is no longer valid. Have a look at the example here. The market was under pressure here. The market was making lower lows and lower highs. We reach a point where we start having similar highs here, right? And then we start having again higher highs, higher lows. So then I say that the trend is up again, the momentum is coming back to the market, and thus is the market is expected to go high. So this is for the first indicator that we have, which is the trend. The next indicator that we are explaining today is the support and resistance. Support and resistance is a very good indicator if the market is not trending up nor trending down. Sometimes the market is moving absolutely sideways, no clear direction, not up and not down. In this case, when we are having a sideways direction, we simply identify the borders of this movement. The lower border, we call it support, and the upper border, we call it resistance. Support is the price level. Why we call it support? Because it's the price level where every time the value of this asset reach this price, we saw purchasing powers appearing, more demand, less supply, and this is driving the prices to go up and jump up again. So there is a support. We say that there is a support at this price level. So that means there is something like at this level, more buying power coming. Why? Again, technical analysts, they don't care. They care about actions. And this is what they're saying, and we are following what they're saying. Okay, resistance is exactly the opposite. Resistance is the price level that the stock or the market seldom surpasses, or like every time the market reaches this level, more selling pressure appears, more supply, less demand, so we see a decline. So the first strategy when seeing the sideway is to draw the support and resistance, and we simply buy at support, sell at resistance, buy at support, sell at resistance. So it's as simple as this. Okay. Another way of using the support and resistance is to wait for breakouts. What does the breakout means? Have a look here, for example, at this chart. It was for gold long time ago. There was a huge support at $1,500 per ounce. You can see here 3 times the price was reaching $1,500 and it was rebounding. That means there is a huge support. That means every time the gold prices reach this level, so many people seeing it interesting to buy, so more buying power coming, so driving the prices to go high. But what happens if the market break this level? Breaking support means people or traders who were buying previously at those prices, they are no longer interested in buying at these prices. So that means there is something negative on this asset. So this is a very negative indicator. So breaking the support is a very sell and clear sell indicator. On the other hand, surpassing the resistance is also a very important bullish signal. Have a look here at this asset. The market was reaching this level. Every time the market was reaching this level, so many selling pressures appears, driving the prices down. 1 time, 2 times, 3 times, the market couldn't surpass this level. But when the market goes above it, that means people who were selling at those prices, they are no longer interested in selling this asset, but they are just keeping it, and more people are buying. So logically, what does that mean? That means there is something positive about it. And that's why surpassing the resistance is a very bullish or positive indicator to have in mind. So now we covered the trend and support and resistance. So now let's go to the third indicator, which is the moving average. What's moving average? Moving average is another line on the chart representing the average prices for a period that we create. So let's say, for example, if I tell you that I will average always the last 10 days prices and put it on the chart. So every day I will have a new value in this case. So I will be having 2 lines. One line is the average of the 10 days, which is the blue one, for example, and the chart price. Simply now I will compare the price to the average. If I see that the price was below the 10 days average and becomes above 10 days average, that means there is positivity in the market that's driving the prices to go higher than the average that used to on 10 days back. Okay, and vice versa. If the market was above average and becomes below average, so that means there's something negative making the prices to go lower in a faster pace than the average of the last 10 days. So this is very simple and straightforward. So comparing the price to the average. Some people will do 2 averages and they compare the 2 averages to each other. So they do, for example, moving average of 15 days and the other moving average for 50 days. Okay, the one for 15 days is more sensitive to the market because it's representing shorter period, and the longer one, it's less sensitive to the market. And they see any crossover. If the fast one is crossing the slow one to the above, this is a bullish or positive, and vice versa is the opposite. But this is just for next level. For now, you can just take in consideration the comparing the price to the average. So now, after explaining those three indicators, I will tell you a simple strategy that you can use. Okay, I will ask you a question. What if I combine those three indicators together? And I will say that I will not buy unless the three indicators are telling me to buy, and I will not sell unless those three indicators are telling me to sell. In this case, I'm studying the market really good, and from three main indicators that might tell me to buy or sell. So, for example, let's have this example. The market by time, let me take them indicator by like one by one. The market by time was making uptrend, right? Because the market was making higher highs and higher lows. I start making similar highs and lower lows. So that means from the yellow circle, the trend is changing. Okay. So in terms of trend, the market is going down. In terms of support and resistance, you can see here the green line. The market was trying to cross this level one time, two time, couldn't, but the third time the market broke it. So also in the yellow circle, there is another sell signal based on the support and resistance. In terms of the moving average, the market was above the moving average, becomes below the moving average. So all three indicators are now telling me that the market is going down. And what happens after? The market really goes down. So in this case, what we could have done, we could have, if we were holding this position, we could have like get away earlier, not to lose too much, or you can do a short sell, which is you sell here and you buy lower. Okay, the second way, this is another example, the other way around. So the market here, let's take them one by one. In terms of trend, the market here was doing a downtrend, the highs was going down and the lows was going down. We start having higher high and similar lows, so the trend is starting to be shaped up. In terms of support and resistance, have a look at the purple line here, the resistance. The market was trying to surpass it one time, second time, but couldn't. But at the third time, the market surpassed this resistance level. The market was also below average, becomes above average. And what happens after? It really goes up. So buying from this level was a good idea. So this is it for today. I will just now stop the recording and I will take all of your questions.